The broadcast is now starting. All attendees are in listen-only mode.
Right, good morning, ladies and gentlemen, and welcome to another Intelligent Pensions webinar. Today on the lifetime allowance and financial planning opportunities. My name is Andrew Penny, Marketing Director at Intelligent Pensions, and I'm joined today by David Trenner, our Technical Director, and Steve Patterson, our Managing Director. Now, for those of you who don't know who Intelligent Pensions are, we've been working with professional advisors since 1998 to deliver quality pension and retirement advice to clients. We are regulated by the FCA naturally, and as such we can provide CPD certificates of today's presentation, and those can be requested at the end of the webinar. For the duration of the webinar, all attendees will be on mute, but on the right hand side of your screen you'll find a dashboard where you can either raise your hand if you're having any problems and submit your questions, which we will be able to come to at the end of the webinar for a Q&A session. Now, before I hand over to our experts, I'm going to do a quick poll just to get a flavour for how much or how involved people are already with the lifetime allowance. So if I can ask you to respond to the question on your screens. Okay, that's great. Thank you very much. I think we've got almost everyone in. Okay, no, that's really. So I'm going to stop that poll now. I'll share those results with you so you can have a look at it. So clearly, a lot of you have got quite a lot of active clients who you think might be affected by the LTA and potential financial planning opportunities. So hopefully this is going to be a very relevant webinar. And I'm going to ask this question at the end of the webinar just to see if these percentages change. So if I can close that and go back to the presentation, I'm going to now hand over to David Trenner, our Technical Director. David.
Good morning. I'll start off with the agenda. Why couldn't simplification be simple? Talk about benefit crystallization events, a term we've all come to know and possibly not love. Protections that were introduced in 2006 and those that have come subsequently. LTA and defined benefit pensions, which I think is quite an important area to touch on. And then Steve's going to come in with a case study, and we'll then both take questions from you as you have them. Why couldn't simplification be simple? Less than 10 years since it came in, we now have 9 different protections. We've had 9 changes to the LTA, more and more planning issues, but equally more and more opportunities to provide a service to clients. And I think the poll results show just how much effect that's having. The problem with simplification is you can't start anywhere other than where you are. So in 2006, there were all sorts of existing rights and they couldn't start with a clean sheet. I'm sure certain of our football supporters like the fact that their teams start with a clean sheet, even if some of them are not very good at keeping it. So LTA 2006 to 16, I think these are numbers you all know. Pre-planned increases up to 1.8 million, and then political interventions in 2012, 2014, and coming up in 2016. Benefit crystallization events occur when people take pensions or lump sums when they reach 75 or die before 75, and also on transferring to a QROPS. There are currently 13 BCEs. You'll notice that the last of these, 5D, was added in the Finance Act 2015. So that is certainly something aimed at keeping us all on our toes. If you check the Pension Taxes Manual, which is the new Bible for pension techies, you'll find they haven't yet updated it. So movement all the time, but that's good. It keeps it complicated. It keeps clients involved. So what we've got are where you take a pension, BCE1, where funds are designated to provide a member a drawdown pension, BCE2, where a member becomes entitled to a scheme pension, and by a scheme pension we generally mean, surprise, surprise, from a scheme, but as you know, you can get a scheme pension from a personal pension, one or two providers offering that. BCE3, where a scheme pension already in payment to a member is increased beyond the permitted maximum. Clearly, when they set this up, the revenue thought someone is going to think of the idea of having a pension of, say, 10,000 a year with annual increases at 50% to beat the limit. So they thought of that, hence BCE3. BCE4, where a member becomes entitled to a lifetime annuity under a money purchase arrangement. Fundamentally, if someone buys an annuity from a personal pension or a company money purchase scheme or defined contribution. Unused funds at 75 or prior death. Now, this is the area that hadn't been fully considered in 2006 and has given us loads of A's, B's and C's. So BCE 5, where a member reaches 75 under a defined benefit arrangement without having drawn all or part of their entitlement to scheme pension and or lump sum. So they reach 75 without taking benefits. The benefits crystallise anyway under a defined benefit arrangement. BCE 5A, where a member reaches age 75 with a drawdown pension fund or flexi access drawdown. This is often known as a second crystallisation event, as benefits were tested under BCE 1 are retested. So a client retires, takes out his pot of $500,000, takes some tax-free cash, draws no income. All the growth is then tested again. Again, this was something where the revenue saw that there was a chance of avoidance because people would let the fund grow after they'd retired. So BCE 5A came in, and that came in fairly quickly after the first 8. BCE 5B, where a member reaches age 75 under a money purchase arrangement in which there are remaining unused funds. So that's just unvested segments crystallise at 75 in line with everything else. BCE 5C, which is a relatively new one. It must have been disappointing for it that it was only the newest kid on the block for 4 months. Where a member dies before their 75th birthday and unused, uncrystallised funds remaining at death are put into drawdown. So if somebody dies and they haven't used all their segments, those segments crystallise on their death. BCE 5C, if they buy an annuity, the dependent buys an annuity, goes into drawdown. BCE 5D, if they buy an annuity. And that was quite a change from the previous position, because it was the case that if you bought an annuity for a widow, it didn't count towards the lifetime allowance. So someone died with a 2 million pot, you had a 1.5 million lifetime allowance, you paid that as cash, and you paid $500,000 into a widow's annuity with no lifetime allowance charge. They've closed that loophole. Interestingly, they closed it on drawdown first, and then a few months later on annuities. The third area of crystallisation events, BCE 6, where the member becomes entitled to a relevant lump sum, and it goes on to say not all authorised sum payments are relevant lump sums. Examples of authorised lump sums that are not relevant would be small pots. So someone takes their 3 small pots, they don't count as a benefit crystallisation event. If you've got a client with over £1 million in pension, you probably aren't too worried about being able to save 30,000 for the lifetime allowance by doing that, but it's a point to consider anyway. On death, BCE 7, typical lump sum death in service or return of fund under a personal pension. And again, there are examples of authorised lump sum payments that may be paid on death that are not relevant lump sum death benefits. Transfer to cure-ops, BCE 8 is where a member's rights are transferred to a cure-ops. For someone living abroad, it's fairly logical. They're coming out of the UK system, so their pensions are measured at the point they come out of the UK system. However, it is possible for someone in the UK to transfer to a QROPS. Now, this has been quite controversial, but under current legislation, if you transfer to a QROPS, you crystallise your benefits at the point of transfer, and the growth doesn't suffer a second crystallisation event. It's something that, if you're interested in, we can discuss further, but it's difficult to know whether the revenue would stop it if they could. The final category is the wonderfully named Other, BCE 9, which is basically all the bits and pieces that previously got missed have been consolidated into BCE 9. And just to remind you, up to April 2011, BCE 1 also arose where the member reached 75 with uncrystallised funds in a money purchase arrangement. That's now been replaced by 5B, and at the same time, unsecured pensions and alternatively secured pensions, which I always thought were wonderfully named, since alternatively secured pensions were so alternatively secured that they weren't secured at all, and they were replaced by drawdown pensions. I think Andy is now going to give you another question. And you can see the question there. This is specifically clients who have needed protection or need protection.
Okay, I'm going to close that poll now. I'll share those results with you. So we see there that, albeit a lot more people are affected by the LTA, fewer people have actually got the protections in place. So perhaps there is scope for significant amounts of financial planning opportunities there. So that's good news. I shall hand back to David.
Okay, well, we had 4 protections when simplification first came about. We had primary protection, we had enhanced protection, we had protected tax-free cash and protected pension ages. Primary protection was going to be the only protection which protected what you had and allowed you to index link it. But people were concerned that someone who had a large pool of money that they built up in pension funds within all the revenue limits that applied at the time could well be penalised on any growth over and above inflation, which is why we got enhanced protection coming in. Protected tax-free cash, you could have had more in 2006. You can protect it. This is one of the great ones because there's no formal protection, and we're now reaching the stage nearly 10 years after this came in where a lot of schemes are saying we don't offer protected tax-free cash because we don't have the information, which I think is very disappointing. Protected pension age is for people who had retirement ages below age 55 and were allowed to protect them. You may remember there was a whole list of professions that had retirement from age 35 onwards. So those went completely, and you can still protect them, but you lose that protection if you transfer. Then in 2006, following 2006, we've had new protections. Fixed protection, it didn't have a year because just like when Jaws came out, it wasn't called Jaws 1. So fixed protection wasn't called Fixed Protection 2012. But in 2014, it was a second one and got the identifier. Similarly with individual protection, and now we've got Fixed Protection 2016 and Individual Protection 2016. Enhanced protection basically took you out of the system. You had £17 million in your pension fund on A day, you didn't pay in another penny, you kept the protection. Fixed protection came in 2012, and worth bearing in mind, that by then you already had a limit, which was 1.8 million. So unlike enhanced protection, you're not out the system, but you retain 1.8 million, providing you don't pay anything further in. Fixed protection 14, the same principle, and fixed protection 16 would also be the same principle. So all of those four protections protect what you've built up, providing you do not have relevant benefit accrual, and in the case of the last three, providing you do not exceed your protected lifetime allowance. Primary protection was the original protection. You've already got 1.5 million. We brought in a new rule. You're protected. Individual protection is the sort of latest version of primary protection. We've changed the rules. You've already built up a certain amount. You can protect it. Of course, the big difference with individual protection is that it didn't come in until 2014, and therefore, before it came in, you were already subject to a 1.5 million limit, so you could only protect the excess over the lifetime allowance up to 1.5 million. Similar situation with individual protection 2016, you can only protect the excess up to 1.25 million. And we are looking at these all protect what you have a set date, but not what you build up later unless the LTA rises. There are currently three protections available. If any individual wants to have protection, they can apply for the original individual protection, which is available up until 5th of April 2017, or they can have fixed protection or individual protection. And from a planning point of view, clearly it's important you get the right one. Now, there will be those of you sitting there saying, I'm sure I haven't seen the forms for fixed protection 2016 or individual protection 2016. And if you're thinking that, you're right. Pension Schemes Newsletter 71, which was published in August, said we aim to provide more detail around the new protection regimes in the next newsletter, and they plan to publish it around September. Well, yesterday morning they duly published it, but at that stage they were saying the legislation for these protection regimes is expected to be included in Finance Bill 2016, which is likely to be published in draft before the end of this year. And yesterday they duly published it. Legislation for both of them will be included in the Finance Bill 2016, but unlike previously, it will not be possible for scheme members to apply for protection until after April 2016. This means that individuals cannot notify us, i.e. the revenue, of their intention to rely on FP16 in advance. Now that's quite strange because they clearly know how to do protections. We've just noticed they've done several in the past. But they are saying you can't protect until we bring out the form. What is obviously crucial for all our clients is that we get it through to them that although they can't apply for protection, they must not pay a contribution after April. If they're in an auto-enrolment scheme, they need to opt out before the April contribution. If they're in another employer's scheme, if it's the right thing to take fixed protection 2016, they need to opt out of that. I would say that it's not a clear-cut situation whether you should take fixed protection 2016, particularly obviously if the employer is paying significant contributions. I want to talk briefly about LTA and defined benefit pensions. Defined benefit pensions are measured using a factor of 20, and you will remember that for pensions that were already in place before simplification, a factor of 25 was used, which was intended to sweep up the tax-free cash, and that can work out in your favour or against you. The factor of 20, which is unbelievably crude because it applies for everybody, has nonetheless stayed. So a pension of 25,000 a year is valued at 500,000 for LTA purposes. It doesn't matter if you pay it at 55 or 75, and that is obviously an opportunity for someone in a defined benefit scheme to take early retirement with a reduced pension and reduced lifetime allowance. It doesn't matter if it includes widow's pension or not. So someone, excuse me, someone at retirement has the option to surrender part of their pension to increase their widow's pension, and that will reduce their LTA value. And it doesn't matter whether it increases in payment or not. So an RPI-linked pension for the purposes of the LTA is valued the same as a non-increasing one. Now, this obviously has implications when you're looking at a transfer. A client age 60 with 25,000 a year index-linked pension payable immediately with 2/3 widow's pension, transfer value is going to be close to £1 million. Transferring from DC could create an LTA issue when none previously existed. Obviously, in some cases, it will be moving from 800,000 to 1.5 million. So even with protection, you could be in trouble. And it clearly is something you need to look at very carefully. Transfers are risky for advisors unless you do them all the time. This is the sort of thing that you're going to pick up if you're doing them all the time. If you do one transfer a month, it's the sort of thing that could pass you by. That's not because you don't know it, it's because you just haven't seen it recently. And just a wee point at the bottom there, we do them all the time. I was quoted recently in one of the trade papers as saying that last year we were doing about one a month. We're now doing one a day. And that does mean we know exactly what we're doing, and we will hopefully pick up all the quirks. Clearly, if you outsource to us, you don't care whether we pick them up or not because we're liable. Thank you.
Right, thank you for that, David. Okay, so that's kind of covered the technical knowledge around the lifetime allowance. And if you have any questions for David, do submit them at any time, and David will be here for the Q&A at the end. So now we're going to go under the bonnet of the LTA and look at some of the nuts and bolts and practical implications for actually giving financial advice around the LTA issue. So Steve Patterson, Managing Director at Intelligent Pensions, is going to join me, and he's going to go through a case study around the lifetime allowance and go into it in a bit more detail. So over to you, Steve.
Thanks very much, Andy, and good morning, everybody. So as David has explained, there have been a series of changes in the lifetime allowance over a period of years, and at each change there has been the opportunity for protection of one form or another. The planning conundrum, I think, is looking ahead and deciding, for example, whether ongoing contributions should be continued or should somebody be applying for protection. In terms of the impact of the lifetime allowance, presently, of course, we have three levels, 1.8 million, 1.5 and 1.25, none of which can realistically be expected to change. With the introduction of the new allowance from April next year, that's going to increase in line with CPI from 2018, and so should eventually overtake the current limits. This is the position assuming CPI averages 3% per annum, and shows that the 1.25 million LTA could be overtaken within the next 10 to 15 years, 1.5 million in the next 15 to 20 years, and 1.8 million in 20 to 25 years. This obviously raises a number of issues. Firstly, from an advice standpoint, the likelihood of the LTA being abolished at some point has now reduced as a result of this CPI linkage. Secondly, the potential impact of the lifetime allowance could affect many clients in the longer term whose funds are currently nowhere near the £1 million mark. That in turn has a bearing on advice regarding ongoing contribution levels as well as investment strategy. Here we look at the position for a client who currently has a £500,000 fund with no further contributions being made. This shows that at a 2% real rate of return, measured against CPI rather than RPI, the LTA would be unlikely to be breached in over 30 years. This, of course, would be considered a relatively low-risk investment strategy. Of course, if ongoing contributions are being made, that exacerbates the problem. However, at a 5% real rate of return, even if protections are in place, there is a far greater likelihood of the LT being breached. A more aggressive investment strategy may therefore be penalised. This is a problem for advice, especially given the unknowns. What will CPI be in the years ahead? What fund growth rate will be experienced in practice? And how would future contributions, for example, from an employer, impact on the result? In one sense, employer contributions aren't a major issue, it's the client contributions that are more important. But the impact on these will depend, in part, on how much the employer is contributing. However, telling clients to stop contributing prematurely also has potential consequences. They will obviously pay more income tax. They could also be increasing their taxable estate and thereby potentially lose out on the new favourable tax treatment of pension death benefits. So simply diverting savings into ISAs, for example, is not necessarily best advice. So this is a planning conundrum, and planning is key. Obviously, very few clients are aware of the potential implications, and one of the interesting developments we've noticed recently is the number of inquiries coming in from firms of accountants. They are obviously aware of the issue. It's something that you may wish to consider yourselves, and indeed if anybody wishes to look at doing joint seminars, we're certainly amenable to looking at that in order to engage with local accountancy practices and explain to them the problems that their clients may unwittingly be walking into as a result of advice being given by the accountant for contributions to be paid, whether it's a small private company or whether it's individual personal contributions from a professional person or self-employed businessman. We've actually seen examples where the potential tax charge is as much as a six-figure sum. That's on the 55% tax charge rather than the lower tax charge applicable to pensions. People with DC pots on top of DB pensions are particularly at risk, and certainly now relying on the LT being abolished is a high-risk strategy. For those of you who attended the last webinar, this is a variation on the previous case study in which we looked at the position of a retiring NHS consultant. On this occasion, I'll be looking at the potential impact of ongoing contributions to a personal pension that has been funded from private consultancy earnings until now, and these are due to increase as a result of him retiring from his NHS post. This is a screenshot from our retirement analysis system, which links into our LTA computation model, and it takes into account existing and projected benefits. The scenario shows future net income in present-day terms. His NHS pension, which forms the bulk of his retirement income, and this is just over $46,000 a year gross and nets down to around $38,000 a year. We also take into account in the model other pensions and investment income, for example, both spouses' state pensions. In this case, it's the IFA's estimate of future dividend income. Currently, this is all being reinvested. His private income is expected to increase, and his best estimate is around $75,000 a year gross. This shaded area is the projected annuity at 75 from his existing personal pension, currently valued at around $140,000, and by default is shown as a joint life index-linked annuity based on current market annuity rates. He and his wife have estimated that they need around $60,000 a year throughout retirement to live off. So we can see that he has excess income available between now and 66, which is when he plans to fully retire. Looking at the income tax position, his NHS pension is £46,200 a year, and therefore any additional earnings will incur tax at 40%. He estimates his private practice fees will be around £75,000, but what he hasn't appreciated was that this would take his gross income over £100,000, and he will be losing his personal allowance. And in this study, his personal allowance is wiped out completely. In effect, on his consultancy earnings above £100,000 a year, they'll be taxed at 60%, not 40%, as a result of the loss of personal allowance. Having considered this, he says that he will increase the contributions to his personal pension to £21,600 a year to mitigate the 60% tax. He views his personal pension as a legacy planning arrangement, primarily to provide extra pension for his wife on his death, but with an eye towards any residue passing down to the children on second death. The challenge is to consider what impact this extra funding would have in relation to the LTA. So as things stand, his current fund is £140,000. Having just retired from the NHS, he's used up 73.6% of his NHS pension. And assuming no benefits will be taken on his personal pension, he would reach 75, and the projected fund at that stage would be around 364,000. By then, the standard LTA would have risen to 1.4 million, and no LTA charge will arise. He is, of course, assessed under BCE 5B for this purpose, having left his personal pension uncrystallised all the way through to 75. Let's now factor in the additional contributions over the 6-year period, and we can see that the projected fund is nearer £700,000, and as before, this would be assessed under BCE 5B. Allowing for the uplifted LTA, he would have a projected LTA charge of around £78,000 at 75. So while he has saved £77,760 in income tax, this is effectively wiped out by the LTA charge, or what might be called a nil-sum game. The next question is what can be done about it. One of the useful things about this system is that our analysts working with the IFA can carry out instant scenario analysis to see the outcome based on different simulations. And this is done either face-to-face or via a web link with you and your clients. What we're seeing here is a position if he crystallised as much of his personal pension at 66 to take him up to his LTA by that stage. Two things arise from this. Firstly, as we can see, if he draws down none of the crystallised fund, he accumulates a BCE 5A liability, as David explained earlier on. That's the growth on any previously crystallised benefits. Secondly, he has the remaining BCE 5B based on the LTA, based on the remaining uncrystallised fund at that time. Bearing in mind that he cannot obtain fixed protection, the net overall position therefore hasn't improved, and in fact it's slightly worse. The next simulation is to look at what happens if he crystallises the current personal pension now and the top up at 66. On the face of it, this looks quite attractive. His current pension plan is just over 140,000 and uses up 11.2% of his 1.25 million, leaving just over 15% available to offset the second BCE at age 66 based on his top-up plan. However, it doesn't solve the BCE 5A problem, and indeed this inflates to an even higher value by age 75. So this is something of a catch-22 scenario. There is a strong temptation to adopt the bird in the hand approach, save the tax now and worry about the deferred tax later. In this scenario, this is likely to be what we would recommend. The choice then becomes one of a deferred BCE5A charge or drawing down an income from 66 to 75 to avoid that. This decision can, of course, be deferred until he retires at 66, and a view taken at that time and on a year-by-year basis thereafter. In the meantime, mitigating 60% income tax makes sense, but on the other hand, planning steps should be included as well. So, to summarise, the optimal, if imperfect, solution appears to be to take his tax-free cash now and gift it to his wife, or perhaps into a loan trust in his wife's name, take the next instalment at 66 and similarly pass this on to his wife, and then, subject to review, potentially draw down enough income between 66 and 75 to mitigate the BCE5A charge, again passing this to his wife. Provided this is only subject to 40% tax, it probably will make sense, since assuming he survives beyond 75, and any cash his wife receives from the pension fund would be taxed at least at 20%, bearing in mind her spouse's NHS pension, so the marginal tax cost would be 20% at most. So in this scenario, then potentially he has the opportunity to avoid the LTA charge completely. He saves the income tax at 6% over the next 6 years, and avoiding the LTA charge at a marginal cost of 20% on the pension drawdown income. The alternative, of course, is to accept a 25% reduction on the BCE5A fund at 75, and so ultimately this could be a finely balanced decision. I think the key thing about this is that you will have gone through a robust process with your client, and your file should therefore stand scrutiny. Thank you for your time.
Right, thank you, Steve. Okay, well, I think that's undoubtedly demonstrated that this is a complex area of financial advice. Now, if I can indulge me a second, I just want to put up the same survey question or same poll question that I did at the very start. I don't know that I'm necessarily expecting different answers here, but if you could vote again, I just want to see if anything within the webinar has triggered any sort of changes as to whether or not you think there's more areas for financial advice, fewer areas, or what. So if I can leave you to vote for a couple of minutes, that'll just give me a couple of seconds just to let you know that our lifetime allowance guide and a series of fact sheets can be found on our website within the technical library in the financial advisor section. We are currently working on a guide to the annual allowance and a guide to pension death benefits, and we will be looking to deliver those over the coming weeks in the same format with a number of fact sheets and with webinars to support it as well. So I'm just going to close that, and I will share those results with you. And I think it's reasonably consistent. I think there's more people saying that it's going to be more than 20, so perhaps there's more scope for financial planning in this area. Now's an opportunity for you to ask questions of Steve and David. Now we've had a couple in already. I'm just going to close those down. So firstly, the first one, which is nice and easy because I can do this one. Can I get a copy of the slides? Yes, there will be a short survey at the end when the webinar finishes. There's about 2 or 3 questions on there, and one will allow you to request a CPD certificate, and one will allow you to request a copy of the slides, and we'll get those out to you ASAP. We will also host a recording of this webinar in the technical library on our website in due course. Another question we've got in here, which I think, Steve, you touched on briefly, but let's just clarify this. Do you foresee any other changes or future changes to the lifetime allowance?
Well, interestingly, I did have a conversation with Steve Webb recently, the former pensions minister, about this, and he, in spite of the fact that there is a CPI linkage, he does feel that there is a possibility at some point that with the reduced annual allowance and the reductions, a reduction in the relief available to higher earners, that at some point it might be seen to become, that the LTA may be seen to become redundant. But I think it would probably be a brave future government who would actually abolish it, given the fact that it does have the CPI linkage. I think there could be an argument for changing that to an NAE link rather than CPI to more accurately reflect increasing earnings. However, one thing I would say is that in our view, it's very, very dangerous for advisors to rely on any future change in legislation. I think that certainly our view that the safe advice to give is based on known legislation, not on taking a chance that legislation will change in the future.
Perhaps I can just add a little there. Ros Altman is a known opponent of the LTA, but the big problem is the annual allowance from 2006 to 2011, where there were 5 tax years when people could put in excess of £200,000. Now, if somebody did that and they were in their mid to late 40s at that time, then those contributions are going to be in the system for more than 20 years to come, and abolishing the lifetime allowance on the strength of a reduced annual allowance would create huge complications if you tried to restrict those people. And I think that if push comes to shove, that one argument could be used to retain the lifetime allowance for 25 years. It's a bit sad, but it's the same thing as simplification. You can't start from where you aren't.
Okay, thanks guys for that. A couple of questions in here which I'm going to tackle before I go on to a question that's come in around the pension consultation, because these two are quite easy and related. The first one, which is a beautiful question for us to receive, how does an IFA interact with intelligent pensions and what are the fee splits? I'm not going to go into that in detail, but that's what we do. We work with professional advisors. Please look on our website for the Contact Us page. We offer a range of solutions, different range of fee splits. And we've got guys dotted around the UK who would be delighted to make contact and let you know more about those. And a related question on this, which I think is one that we will pick up, do we offer a one-off LTA reporting service? So Steve, I think you touched on that, but if you could go into that in a bit more detail.
Yeah, we're getting an increase in demand from this. I mentioned earlier on about accountancy firms contacting us, and I think this is good territory for IFAs to develop, and we do provide one-off LTA reports. The cost ranges, but typically between £500 and £1,000, depending on the complexity of the case. And we do have some fairly complex cases that we look at. Sometimes following submission of the report, we're asked to re-report on a different scenario. Obviously, there's a different charge for doing that. But I think the good thing from your point of view is that if you can use the LTA, and obviously we can provide some case studies as a way to get into local firms of accountants and indeed solicitors, but accountants in particular, because very often their clients are relying upon them to tell them about contribution levels. I mentioned earlier on private companies, and we've had some situations where it's been an EPP or a SAS scheme, and the accountant was just totally unaware of the impact of what he was suggesting the client company does to shelter profit from corporation tax. So it is a good opportunity, and we are certainly quite happy to provide standalone reports.
We've also got a service for annual allowance queries. We're now looking at more and more people who are earning reasonable amounts, get a promotion, and suddenly they've got a potential annual allowance charge because they were lucky enough to have a defined benefit scheme. And the obvious question is it worth my while paying a lifetime allowance tax charge, or should I opt out the scheme? And telling someone to opt out the scheme is a high risk advice, but it may well be correct.
Okay, thank you very much. And now a question which is a hot topic, and one that I know we'll be able to cover in detail, having submitted our response to the consultation on pension tax relief yesterday. This question comes in and says, do you think they will dispose tax relief on pension contributions?
Again, a very interesting question. David and I were at a pensions networking event about 2 weeks ago, and they did a poll, and a high proportion thought that there would be a change in the tax relief position. As it happens, unbeknown to each other, we put our hands up to say no, we thought there wouldn't be a change for the foreseeable future. And it was recently reported in the Times newspaper that ministers are backing off from introducing a change. My own view is that there's been so much change recently that bringing in further change, particularly if it's messing around with the tax relief situation, would be very counterproductive for the government. Having scored a goal, as it were, with pension freedom and choice, I think it's likely to be an own goal, and I personally think they will back off from it for the time being, and it may not happen in the current Parliament.
Yeah, I think, as Steve says, we were sat on opposite ends of the room for obvious reasons, and we both raised our hands there. We certainly don't think it's there. It's already going to be complicated for payrolls trying to administer the taper relief that's going to be available. If you've got a defined benefit or a company DC scheme and the contributions are over 10,000 for your staff earning over 150,000, particularly anyone earning 210,000, that is going to be a big problem for payroll systems. And that is the sort of problem that coming up with an idea that sounds like it has some attraction tends to fall down on. It's all very well in principle, but it's very difficult to implement in practice.
Okay, thank you. I think one thing is clear, that pensions are still always going to be the subject of change and speculation, and I don't see that going away in a hurry. But yeah, time will tell. We shall wait and see what the response is. Okay, well, thank you all very much for your questions. That's been great. I'd just like to thank David and Steve for putting together the slides and their efforts today. And thank you all for attending. And hopefully we'll see you at a future webinar or at another event in the near future. So thank you all very much for your time. Cheers. Bye.